It's said that day trading is the hardest way to easily make money. In order to become a successful day trader, you need to understand why between 85 to 95% of all that attempt to become day traders fail and lose all of their money. In this video, I will tell you what most of these people are doing wrong. Before we dive into all the reasons why people fail at day trading, I would like to show you some statistics. 85 to 95% of all that tries day trading fails and lose their money. A well-known expression in the trading community is 90-90-90, which means that 90% of traders lose 90% of their capital within the first 90 days after opening a trading account. 40% of traders only trade for a month before they quit. And as much as 80% of all traders quit trading within the first 2 years. The last, but maybe the most important one, is that only 7% of all that started out trading still remains after 5 years. Let that last one sink in for a second and let me rephrase it so it's more understandable. Only 7% of all traders put in the necessary work to become successful in this business. So, let's look at the reasons why people fail and give up on the day trading dream. Most people that are being drawn into day trading are looking to get rich quick. Some have probably watched clips on YouTube or Instagram of all the people living the dream. They drive fast cars, they fly private jets wherever they go. These people usually brag about how easy it is to get financial freedom by day trading. They make it seem so easy, just put all your savings in a trading account, buy the trading course or signal group that they offer, and get rich. In extension, many have seen clips on YouTube of people flipping accounts and thinking it's no problem depositing $100 and trade it up to 1 million. Others are drawn to trading because they want to gamble their money like if they were on a casino. They can blindly bet if the price goes up or down. It is in fact possible to get lucky and guess the right move. And some might think that trading must be easy, and that they already have the upper hand, because we all know that it's so easy to look at a chart from yesterday and say, I knew the price was going into a downtrend there. If you haven't guessed it yet, day trading or trading in general is not a get-rich-quick scheme. It requires hard work and for many years of trial and error before they start earning money. If you're looking for a shortcut and isn't ready to do the required work day in and day out, you will lose everything and then some. Don't get me wrong, it is possible to become very rich trading, but it will not happen overnight. The next thing I wanted to address is stop losses. Depending on what source you use, roughly between 60 to 80% of all traders do not use a stop loss. If you don't know it, a stop loss is a predefined price point on the chart. When price goes against your trade and hit this point, your trade will close automatically. There are several reasons why traders choose not to use a stop loss. Some think that they can just wait it out and exit when they feel they are ready to do it. The problem doing this is that you will let a losing trade become a much bigger loser before you close it. If I just let it run a little more down, I know it will come back up. This is also true for those too lazy to set a stop loss. What's the point? You're watching the chart and can easily exit the trade if it starts to run against you. Then you quickly walk to the kitchen to get yourself another cup of coffee. When you return, you see this on the chart, and your broker is giving you a margin call. Others are trusting their technical analysis so much that there is no need to use a stop loss, since they know that the market is going their way anyway. These people usually blow their account pretty fast because no matter how good your strategy is, the market is controlled by human behavior. This means that anything can happen at any time. Even if the last 10 times your pattern appeared it was a winner, this time it could be a loser. And the last one I want to mention is those who actually set an initial stop loss. Then the price starts to go against their position, and instead of either closing the trade or let it hit the stop, they move the stop further away to give the trade more room. This also makes a losing trade a bigger loser. So, what should you do? A popular saying is, cut your losers early and let the winners run. Before entering any trade, you should always have predefined your risk and the point where you want to exit the trade. This point should be a technical point where you safely can say that if price moves past this point, my trade is no longer valid and I'm out. This is the point where you always should place a stop loss. These technical levels could be a moving average, swing high or low in price, 2 times the ATR, or right beneath a support level. This should be defined in your strategy. Remember, the stop loss is not there to prevent you from making money, it's there to prevent you from losing it, by cutting your losers as soon as the technical analysis finds it improbable that the price will go in your direction. You should view this predefined risk as how much money you are willing to spend in order to find out if the trade is a winner or not. Another reason most traders fail is poor risk management, or in many cases, no risk management. This one is closely related to using stop losses. Risk management is all about preserving your capital so that in the end, your account survives with a rising equity curve. Most traders either go full margin on the trades, meaning they are going all in on every trade, or they risk 30 to 80% of their capital on trades, varying based on how confident they are in the trade. If you risk 30% of your capital on each trade, it will only take 3 trades for you to go bankrupt. If you risk 50%, the number is 2. There is no exact answer to how much you should risk per trade. It depends on your trading style, if you're swing trading, intraday trading, or scalping. It also depends on what your maximum drawdown has been during testing and live trading. What's most important is that you can sustain losses without risking half of your account. My recommendation to not blow your account and still have the ability to handle a drawdown is 1% or less. You should only risk 1% or less of your capital per trade. This means that if the trade you put on hit the stop loss level you placed at a technical level of importance, then you should only lose 1% of your capital. If you risk more than 5% per trade, it's considered gambling. The reason being that even though your account still has 50% capital, after a losing streak of 5 with a 10% risk, you would have to make 100% of your account in order to break even. In order to make your trading sustainable, you should always risk the same amount on every trade. If you vary the risk, you could end up with small winners and big losers. I will cover this more in another video, but the proper way to mix your actual risk with the stop level on the chart is as follows. First, you set a technical stop loss point at the chart. In this case, the stop loss is 7 pips from the entry. Let's say that your trading account is $10,000 and you want to risk 1%, that's $100. By using a calculator, you then find that your position size should be 1.429 standard lots if trading a major forex pair. So if the stop now gets triggered, you only lose $100. By doing it this way, you can control your risk while still having the freedom to put the stop loss where it should be placed according to your strategy. You might think that 1% risk to gain 1 to 5% isn't much, and it isn't if your trading account is $100, but when your trading account is $100,000, it's a lot of money to potentially gain per trade. The next reason why so many fail at day trading ties into the previous ones. Most traders have insufficient startup capital when they start trading. They put $100 or even $1,000 into a trading account and think that they are on the verge of quitting their day job. It's not that it is impossible to trade successfully with $1,000, but this ties into the unrealistic expectations many have when they start out trading. With brokers offering leverage as high as 1 to 1,000, it's easy to get tempted and think that you can flip your $1,000 account into $1 million and get rich quick. You know that good risk management is essential to succeed in this business, which means that depending on where you live in the world, it would probably be very difficult to earn enough money from $1,000 to make a living. Most people doesn't have $100,000 to casually put into a trading account when they are starting out. But there is actually a solution for that. Once you have learned to trade and consistently make money, you can check out one of the online prop firms. With these firms, you can pay a fee to take a trading challenge. If you pass, they will refund your fee and give you access to a trading account with up to several $100,000. The profit split is usually between 70 and 90% of what you make each month. This makes even a 5% return a very lucrative deal. Just keep in mind that prop firms earn most of their money from people that can trade, looking to get rich quick. Be aware that there is also a lot of unserious prop firms, so do your own research before investing in any of these. The next reason why most people fail at trading is because they don't have an edge in the market. You can do everything else right, but if you don't have a statistically proven edge that puts the odds in your favor, you just cannot win in the long run. Even with the best risk management, you will not make it if you're losing more money than you are making. Most traders either guess where the market is going, or they have some random confluences that makes them enter a trade. This might work for a while, but when they encounter a losing streak, they don't know what they are doing wrong. It's important to have an edge in the market that you have statistically proven through backtesting and forward testing. This edge, or strategy, needs to have predefined rules on when to enter the market and when to exit. You need to do the same thing every time you enter the market in order to find out if your strategy is working and if you are following it as planned. Another thing many losing traders do is that they take a backtested strategy that statistically have a proven edge and trade it for a short while. Then they encounter 3, 4 or maybe 5 losses in a row, and they toss away the strategy as if it was the devil himself. They then jump on another strategy, which of course after a short while give them a drawdown, and they change again. Most traders don't understand that trading is a game of probabilities, so when they encounter a losing streak, they immediately think that their edge has stopped working. Many traders set out on a quest to find the holy grail of trading strategies. These traders also jump from strategy to strategy in the hope of finding a strategy that gives them 100% win rate. If you are one of those looking for the holy grail of trading strategies, you're in for a disappointment. It doesn't exist. If there had been such a strategy, you would have seen it on top of the Forbes list of the richest people in the world. The reason why this is impossible is because it's human behavior and emotions that moves the price up or down. This means that anything can happen at any time in the market. Losses are part of trading. It's okay when you're starting out to switch between strategies to find out how you like to trade and what kind of trader you are. When you find a strategy you like to trade that also have a positive expectancy in backtesting, stick to it. Backtest, forward test and tune it until it's how you like it. Many traders fail because of overtrading. There are many reasons to why people tend to overtrade. Some want to trade more than the market and their strategy signals them to do. Others might be angry because the market took their money away and they want to win it back by revenge trading. Some are just greedy and want to make more money than the market is giving them. And some sees a big move and is experiencing the fear of missing out. What all these reasons have in common is that it leads to taking on trades that doesn't fit the entry criteria for your strategy. It can be that the criteria were almost met or that you have convinced yourself that this trade is a winner, regardless of what your strategy tells you. Either way, you will probably end up losing a lot of money if you choose to go down this path. To overcome this, you need to focus on being disciplined and follow your strategy. If you start to get emotional in any way, just leave the chart for the rest of the day, review and come back tomorrow. Most traders trade without a trading plan or without following it. A trading plan must not be confused with a trading strategy. The strategy, or edge, defines your entry and exit conditions in the market. The trading plan, on the other hand, is everything else. In order to succeed, you need to treat your trading as a business. I will cover this in more detail in a later video, but your trading plan should contain everything. From your short-term goals to your long-term goals, your risk management, money management, max daily drawdown limit, etc. This plan should be reviewed and readjusted on a regular basis. Most traders don't journal their trades. It might seem like a small thing, but if you don't journal your trades, you will not succeed in trading. When we talk about journaling, I'm not just talking about the statistics of when you traded, how much, and if it was a win or loss. I am talking about really writing down everything around your trading. Did you follow your strategy? How did you manage the trade before and during it? In retrospective, could you have done anything else? You should, if not every day, but at least once a week, review all trades taken and write a summary of the week. This should include all technical sides of trading your strategy and your emotional and personal side. Think of it like your diary. Do you have problems with jumping the gun and entering a losing trade before your entry signal appears? Do you move your predefined stop loss further away after setting the trade because you hope it can reverse if it just goes against me a little more? Or do you struggle with cutting your winnings short by taking profits at the first pip above break even? So why is this important? It's important because for most traders, trading is a lonely game. Most doesn't have friends or family to talk about trading or their challenges in trading. So the only way to actually review what you did and why you did it is to write it down for yourself. If it's only in your head, it goes away during the weekend and is forgotten on Monday when the market opens again. In the statistics at the start of the video, I told you that only 7% of all day traders remain after 5 years. This is the people that were willing to do the hard work to become consistently profitable. This is the group you would want to belong in if you want to succeed in this business. So, to summarize why most traders fail. They think trading is a get-rich-quick scheme. They are not using a stop-loss or predefining their risk before entering a trade. They have poor risk management. They have insufficient startup capital or unrealistic expectations. They don't have a statistically proven edge in the market. They are jumping from strategy to strategy either because they have lost faith in it or because they are looking for the Holy Grail. They overtrade. They don't have a trading plan. And they are not journaling their trades. If you start doing what most traders don't do, you have a much higher chance of becoming successful in this business. Make sure to like the video and click that subscribe button if you want me to create more content like this.